All right. Good afternoon, everybody, and welcome to today's webinar, How to Use Retirement Funds to Passively Invest in Real Estate. I'm Erica Figueredo, the marketing specialist here at Next Generation, and we have an exciting presentation for you today. But before we get into that, I wanted to review just a couple of housekeeping items, introduce our speakers, and tell you a bit about Next Generation and what we don't do. So as always, today's session is being recorded and will be available for on-demand viewing. For anybody that didn't have a chance to make it live, if you are here with us live, welcome. And you'll be muted for the entirety of the session, but that doesn't mean that we don't want to hear from you. So take some time, introduce yourselves in the chat box, and feel free to use that feature to engage amongst yourselves as we go through today's conversation. If you have any questions at all, you can use that chat feature to ask questions, or you can use the dedicated Q&A box. It should be on the right-hand side of your screen in your GoToWebinar control panel. And if at any point today you can't hear any of the speakers, please let us know in the chat box as well. So without further ado, let me introduce our speakers. So first we have our co-host, Charles Sells. Charles began his career investing in tax liens at the age of 23. Like many of us, he was enticed by the simplicity and profitability often conveyed in popular coaching programs and weekend workshops. However, experience taught him that success required more than a simple snap of the fingers. So at 26, Charles kicked the pitchmen to the curb and started his own business, helping investors discover realistic profits investing in distressed real estate. The model was simple. Use his growing knowledge, integrity, and tenacity to help others grow alongside him in experience and in profits. One investor at a time, Charles has built a reputable business helping individuals invest passively in everything from tax liens to the ever so popular fix and flip. Fast forward 20 years, and the PIP Group has transacted hundreds of millions of dollars in distressed real estate investments on behalf of nearly 1,000 investors worldwide. Charles and his team at the PIP Group have taken the stress out of investing in distressed real estate by enabling investors to have their individual investments remain in their name and their control, retaining 100% ownership. With Charles and the PIP Group team at the helm to make certain those investments remain profitable. We also have, as part of the PIP Group team, Business Development and Marketing Director, Dylan DeBellis. He's here just to provide some extra commentary if need be. And as always, we have our Director of Marketing and Sales, Brittany Melville. Brittany applies her extensive experience in direct sales, marketing, and customer relationship management at Next Generation. In her role, she develops and oversees the implementation of our marketing strategy across all media and works with our team to support sales initiatives. Brittany's accomplishments throughout the years include designing and executing lead generation strategies across multiple channels, developing and nurturing multi-million-dollar sales pipelines, enhancing digital marketing outreach, creating digital content or creating educational content, conducting market and competitive analysis, training sales personnel, and improving internal processes to support sales. Prior to joining Next Generation, Brittany held positions at Convergent Revenue Cycle Management Incorporated and Altria Group Distribution Company, which is formerly Philip Morris USA. Brittany graduated cum laude with a BS in Marketing and Business Management from Boston College and is certified as a self-directed IRA professional. Brittany and her husband currently live in Branchburg, New Jersey with their son. She also owns a rental property at the Jersey Shore. In her free time, she enjoys dancing, working out, playing piano, cooking, reading, and cheering on her favorite football team, the Philadelphia Eagles. So now to talk a bit, I know, right? Now to talk a bit about Next Generation. So Next Generation is a custodian and administrator for self-directed retirement plans. So these types of plans are exactly like the ones you'd find at a brokerage like Fidelity or Charles Schwab. However, instead of investing in assets that are publicly traded, such as stocks and bonds, self-directed IRAs allow you to invest in non-publicly traded alternative assets like real estate. So our administrative firm and headquarters, which is Next Generation Services, is located in Roseland, New Jersey, and we provide the record keeping and tax reporting services for all of our client accounts. In addition, we provide the educational content you'll see on all of our webinars, like the ones today, as well as complimentary access to our knowledgeable representatives and other educational content, such as our white papers and blog subscriptions, which you'll find on our website. Next Generation Trust Company, located and chartered in Sioux Falls, South Dakota, provides custodial services for the assets held within our client accounts. So onto our very necessary disclaimer on what we don't do. Next Generation is not a bank or a fiduciary. We do not provide any financial, legal, or tax advice. So any information provided in today's webinar is strictly for educational purposes only. And as always, we encourage you to consult with your trusted financial professional to determine if this strategy or investment is the right fit for you and your retirement goals. So with that being said, I'm handing the floor over to our moderator, Brittany Melville, who will drive today's conversation. Britt, take it away.
All right. Thank you, Erica, and everyone for joining us today. So we know everyone's totally consumed by Zoom and webinars these days, and rather than have a big slideshow and put you to sleep with visuals for the next hour, we thought it would be more engaging and interesting to have a conversation. So we know that if you're here, you're interested in passively investing in real estate, and also might be interested in how you could do that using some of your retirement money. So I am going to ask Charles and perhaps Dylan, if he wants to chime in, some questions about their real estate background and some passive real estate options. We'll talk a little bit about the industry and some trends, and then we'll also talk about self-directed IRAs conceptually. So for anyone who might be new to the idea, just to help you kind of wrap your head around what they are and how they work. And then we can talk a bit as well about how we can put those two things together. So with that said, Charles, I think everyone can probably attest to having some level of experience with real estate. We all have homes that we live in, and we've had some interactions one way or another and some level of understanding of real estate. And it seems that there's a growing interest, of course, now with the market being what it is as well. But some people don't necessarily want to be actively managing real estate investments. So what do passive investments look like in the real estate world?
So yeah, everybody wants to, there's this explosion with the Property Brothers and all the HGTV shows of everybody wanting to be involved on some level. But like you said, passively investing is really what people should be doing. And how do you do that? The way you do that is engaging in people that like us that specifically service that type of investment idea. There's people that do it in every city in the country that essentially work with you to help you invest in investments and specialize in markets to do that. The way it works essentially is a lot of people, they call it a joint venture in some cases, where you form a partnership where you're essentially, a company is a sweat equity partner and you're the investor and you put the money up, they become the sweat equity partner in the relationship. We're unique in the way we operate is that you own the investment outright. So what a lot of people don't know is that self-directed IRAs represent about 60% of our business. And reason for that being is that with an SDIRA, they have to own the investment. That's part of an SDIRA. So to make it passive and to be able to do that, they have to own 100% of the investment. But so they essentially own it and they control it, if you will. But everything is channeled through us. So essentially, we're an agent acting on behalf of the investment. So we know how the investment works. Before this market went crazy all over the place, you had specific areas that were really strong. So you might not be investing in your own backyard. A solid market might have been like our market, which was Savannah, Georgia. We always, before the market went crazy, before COVID, we always said we were a recession-proof market. That being that there were certain driving forces in the market that if the economy took correction, or when it takes a correction, that it was a good passive investment market that is going to survive any kind of market correction. So that's essentially the type of investment that we call passive, that an investor is going to be protected in and is going to be able to invest confidently in going through any kind of market correction, should there be one in the future.
Got it. Okay. And you mentioned sweat equity partners. So for those who are just wanting some clarification on that, is it correct in saying that when you refer to sweat equity, you mean like physical maintenance and repairs type work on a property?
Yeah. So there's a lot that goes into flipping houses. It's not the glitz and glam that you see. We're very hands-on in what we do. I mean, to this day, even though I've been in this business a long time, I'm still boots on the ground. I'm in Savannah every Thursday and every Friday, driving all of our properties, checking on our crews before they get paid end of day Friday. And we go through contractors, at least a crew a year. So it's a lot of work, and that's how we make our money, is staying on top of them. So that's the sweat equity that we bring to the table on behalf of our investors. So that's how we make our money, is being there on behalf of our clients.
Got it. So there's a convenience associated with the passive investment, in that investor partners or does some sort of an equity investment in another entity that then is purchasing the real estate. Maybe that might be one option. That may not always be the way that it's structured, but either partnering or investing in another entity that's purchasing the real estate and then managing the day-to-day, dealing with contractors, getting quotes, estimates, et cetera.
Exactly.
Kind of thing.
Dealing with all the headaches and everything else that goes along with it. For example, Dylan has to deal with the wholesalers, and for every good wholesaler that's out there, there's 99 that are not. And we'll talk about, the acquisition side in a minute as well. But, that's a full-time job in and of itself. So there's a lot that goes along with that side of it as well. So, ideally, passive investments in real estate is if you can find somebody that's good at it, it's a great way to invest in real estate.
And especially for those that have full-time jobs and don't have the time to be running over to a property in the middle of the night.
Exactly.
And I was going to add to that, that anybody can do this, but it's more or less, it becomes a full-time job. And you will be consumed with the day-to-day. So if you don't have the time to be on site every week or on site every moment talking to contractors, if you don't want that full-time job, kind of aspect, then it's the passive side of it is like definitely the way to go. Or you pick up a new 50-hour, 100-hour a week job kind of thing. It's full-time all the time.
Right. Dylan, did you have any other comments you wanted to make on the wholesaling side, or are you good?
Just like Charles said, just that aspect alone, I'm talking to these people, negotiating with these guys 20 hours a week, and that's just to try to find one property. So, we pick up maybe 15, maybe 30 properties from wholesalers a year. So I'm very consumed with tire kickers or people that maybe are very low in experience, so I know more than they at the point, and they're trying to sell me their contract. So if you don't have the time, the passive avenue is definitely of interest for a lot of investors that really just they can't put the time out there, for whatever it is, for whatever reason.
So when it comes to flipping in this space, the term quote unquote buying right, can you describe what that means? Can you help our audience understand that a little bit more? What is buying right?
So yeah, it's a term that gets tossed around a lot, and I could go on. I could probably spend an hour on buying right. So I'll try not to do that. But it's all part of the acquisitions process. And again, it goes to the. I could spend an hour talking about wholesalers on buying right. So emotions play a big role into acquisitions. We buy a lot of our properties at auctions. We obviously haven't since the moratorium's been in place, because the foreclosures are more or less at a standstill right now. But we'll be back into them, and people get caught up with their emotions in sales. It's kind of a mind play, if you will. And you could end up spending way too much on a property just because you think you're playing a game, if you will, and you spend too much on the property, and if you don't buy it right, you get into it, and you spend too much on the repairs, and when you exit the property, you're essentially at a loss. We see a lot. We see this happen all the time. So you've really got to have. You've got to have a mindset in place of what you're going to be willing to spend for the property, and you cannot let yourself be $1 over that price. And you cannot say, okay, well, $1,000 more is going to get it done. You've got to stay within whatever your budget is. You can't say, okay, all right, another $1,000. I'll put laminate in instead of carpet. I'll make up that difference there, because you get into the property and then all of a sudden you say, okay, well, you pull out that wall and you find that there's termites there. So your budget is now going over above and beyond what you even thought it was going to be. So your profits are always on what you pay for the property. It's not on what you do to the property and what you do in the repairs in the property. I mean, it is, but it's always what you pay for the property. So we have wholesalers come to us or come through Dylan all the time, and all he does is they shoot him information, and he sends that to me in a text, and I look at it and say there's no way. It'll be I look at it and it's $115,000, and I say, okay, out the door we're going to be at 150 on that. There's, I'm paying 60,000 for that property. So they're not even in the ballpark. So the rule of thumb is you always have to know what you are going to pay for that property, and you can never go above $1 on that. Because you don't know what you're getting into when you open the front door. There's been so many cases where, another term we use is good bones, right? If the house has good bones, you can do anything with it. Well, you could get in that front door, and we have one right now that it had good bones. And we're like, okay, this is a $50,000 rehab, no problem. Well, once we took the drywall down, it had no bones. So we have to get creative with it. We'll still make up for it because that's what we do. And we do this 100 times a year. But it's again, because we bought right, we have the budget and the flexibility to be able to make up the ground. So rule of thumb, if you're not a passive investor and you want to be out there doing this is when you come up with that budget, always be extra conservative. Always say, okay, yeah, it looks like it's got a good HVAC system, but assume it doesn't. Yeah, it looks like it's got good bones, but assume it doesn't. That way, you're always going to be buying right if you make those assumptions that it looks good, but it probably isn't. Because when you're buying something to flip it, 90% of the time you're not going to be able to get inside it if you're buying it right. 90% of the time you're not going to get it on MLS or buy it from a realtor like all these fix and flip shows start out and go through. And by the way, on every single one of those deals, I can go back and show you, because it's public record, that what they buy for is not what they bought it for, and what they sold it for is not what they sold it for. Those are all made up numbers, so don't believe the reality TV shows that are out there, because it's not. So that's essentially what buy right means. Is don't assume that you're getting a deal just because they're called a wholesaler. And stick to what you said. If you go to an auction, stick to what your budget is. Don't spend another dollar over what you went to that auction for. If you go into the home with the idea you're going to put Formica countertops in, don't get emotionally caught up on it and put granite in because you think you're going to get an extra $10,000 out of it for granite. That's buying right.
Okay, that helps. So don't make buying decisions driven by emotions. And if you're going to buy right, you need to understand your deal breaker price. And to understand that, I imagine you need to have enough experience to be able to figure out what criteria go into calculating that. So if it's something that, like, I'm not, yes, I have a rental property, but I'm not in the business of flips and whatnot. So for someone like me, for example, that's not that experienced, I'm either going to have to do research to make sure that I figure that out, or partner with somebody that's experienced.
Yeah, and you brought up a good point there. You said calculate, and I don't have the information in front of me here, but I know we're doing a phase 2, and I'll have it for that. I think in June. But there's these weekend workshops that have come up with something called Rule of 72, and it's a formulation where they've come up with to create what your buying strategy should be. And I've ripped that rule apart a couple of years ago, and I'll bring that up for the next presentation, where we get into more of the nuts and bolts in the next presentation. Yeah, I just wanted to touch on that. But yeah, the biggie for me is emotion, and I've gotten caught by it before too. And I literally had to buy the property from my client because it was just, and I still have it. Because I got caught up in it. I loved it. It was a 5-acre property with a pond. I'm like, this is so cool. I'm going to put a little beach spot out here, and we're going to put a barn for horses out here, and just stupid ideas. And we bought it right, and then I just got whipped up in the ideas, and just emotion is the biggest killer for any person in this process. And unfortunately, all these flip shows, that's exactly what every single one of those episodes is about. It's trying to be really creative and putting shiplap walls in and that kind of stuff. If you do everything cookie cutter on every single project, your budget's always going to be there. You've got the same color paint for every single property, the same fixtures, everything. So you're always going to be under budget, which is always a good thing. So yeah, just keep your emotions out of it and everything's good.
Yeah,
Easier said than done for some people.
Just to add on that a little bit, I feel like it's FOMO, like fear of missing out. We go to auctions all the time, and there's like 5 or 6 regulars that are there for every auction, and we all know each other. And then we have these kind of greenhorns that come in, and they'll be battling each other, and you see prices just go skyrocket, and we're sitting back, all the regulars, we don't put even a bid on it because it was priced too high to begin with. But they came there with the intent of, I'm going to buy a property today, I'm going to become a real estate investor, and they lost when they left. They put too much money down, and all the regulars know, like, well, we'll see this back on a wholesale deal or something, because they're going to lose their everything on this, because they already lost the investment by buying wrong. So that's why buy right and emotions is number one kind of thing for the acquisition process.
Okay. So earlier we mentioned distressed real estate specifically. I imagine that probably has its own process as well, or some best practices associated with that. How would one go about acquiring distressed real estate assets?
So distressed, distressed is, I wish it had a better term. So distressed essentially is an umbrella of tax liens, tax deeds, foreclosure, pre-foreclosure, short sale, anything that's in default, if you will. So it could just have a couple of missed mortgage payments, and that's considered distressed. So our focus is on foreclosure primarily. So we attend a lot of auctions, and most states they're monthly. Like I said, right now the inventory is very low because there's been a moratorium since all the COVID stuff. That should be lifted on June 30th, and the inventory should come back in. It hasn't been completely lifted. There was a lot of stuff that was in the chain ahead of that, but anyhow, you can research. It's in your local paper every week. You can see what's coming into all those categories: tax liens, foreclosures, all of that. That's where you're going to get your best margins of profitability is through that. Banks have to offer those through foreclosure and offer those publicly through auctions. Now they can set their reserve just like any other type of auction, very high, like Dylan mentioned just a second ago, where you're not going to be able to buy right because their reserve is so high that they want to actually get it sold through traditional means by listing it with an REO agent through the MLS system by traditional means. So the reserve will be very high, and they'll go sell it by that method. In a lot of cases, the mortgage payments were already almost very close to being done, so the reserve will be very low, and those are where you really get the good deals. And so it could be a $300,000 piece of property, and it's getting auctioned off starting at $100,000. Maybe it needs $60,000 worth of work in it. Maybe it needs $100,000 worth of work in it. But that if you get it for 100 and it needs 100 and it's worth 3, that's a 50,000, or that's a 50% gross profit margin in there. So that's pretty good. So those are kind of the deals that you're looking for in buying right is a big spread. So if you get in there and it needs $150,000 worth of work, you're safe. You're still able to do well. So that's what you're looking for.
Okay.
But that's where you're going to find the distressed opportunities. It's all public. Every state offers it. Every state requires it be publicized in a paid publication like your local newspaper. You can find it online now. Every paper is online and digitized, so it's very easy to access it. It'll tell you the date, the time it's going to be auctioned off. What's tricky though is when you go to these auctions, and again, I'll highlight that when we get into the nuts and bolts, is they're literally just sitting on an iPad, and they're just in a shorts and a t-shirt, and they're just reading this stuff off, just quietly reading this stuff off, and it takes them about 10 minutes to go through all the legalese of it, and you really just think they're just sitting there reading a book out loud, and there could be 10 guys reading this stuff off all at once, and you don't even know what they're doing. They're just standing at the courthouse, in the courthouse yard, reading all this stuff off, and it's actually they're selling houses. So it's kind of fascinating, honestly. So if you don't know who is representing which house, or which law firm, you don't know which one you're actually bidding on. So you got to be careful with that as well, and understand who's selling what.
And as far as the investment process itself, can you describe from acquisition to liquidation? I know that's a lot. We might keep it high level, but what can an investor expect to go through in that process?
So if we're talking passive, it's a fairly simple process. If we're talking passive, it's you have a conversation with whoever service provider you become comfortable with, and you engage, whether it be a joint venture partnership, or it's set up like an agency situation, and then it becomes you provide, if it's through a self-directed IRA, the agency agreement becomes a partner, not a partnership. Agency, the client becomes a client of the self-directed IRA, and that client becomes a client of the service provider. And essentially, you make the investment with the service provider. They go make the acquisition at the courthouse steps to purchase the property. Takes about 3 months for that acquisition to be documented, if you will. And then it becomes a very simple process. The purchase is made in the SDIRA's name, so it would be Next Generation for the benefit of John Smith, account number 12345. And then repairs go on. Those are all documented as well. Repairs can take anywhere from 3 to 6 months, depending on the level of repairs. Because it's passive, you're essentially given access to a Dropbox folder, and you can see the ongoing pictures, the documents that all go with it, permits, inspection reports, that sort of thing. So you just log in to your Dropbox file and see how that's all progressing. Everything's done on behalf of you. So listing agreements, all of that is taken care of for you. Closings are attended on your behalf. So again, it's completely hands off. And then the funds, once closing is done, goes back to your self-directed IRA account. And when you're ready to do it again, the process just repeats itself. So it's very, very hands off, but it's also extremely transparent. So you have access to everything in real time. And as I said, about 60% of everything we do is with self-directed IRAs. And why I like working with self-directed IRAs is it adds an extra level of security, if you will, because things have to be done so meticulously perfect in order for it to be compliant, if you will. So it adds an extra level of security and legitimacy, if you will, because you got to put a lot of trust in your service provider to make this all happen. So it's a great way of adding that extra touch, if you will. So in a nutshell, that's how the process works.
Got it. Okay. So the benefits of investing passively, well, with or without the self-directed IRA, is leveraging a resource like a partner or another company to be able to do the heavy lifting on the project, where the passive investor in the IRA provides funds to do that. And there's a level of transparency so that that investor who's providing the funds can see what's being done, but not having to be actively involved in the day-to-day management, and then receiving the benefits through proceeds from sale, or other type of investment income that would flow back into the self-directed IRA, thus benefiting the investor. So they have some level of involvement through that transparency that's provided, but on a day-to-day basis, they can be doing their 9-to-5 job or doing whatever it is that they want to be doing, spending time with their family, while still making that money.
Right. Exactly. Yeah. Yeah. Not dealing with the insanity of the day-to-day that goes on with the investment.
Right. Okay. Makes sense. Do you have any examples that you'd like to share of what a deal might look like with this type of setup?
Dylan, I don't know if you can share your screen or not. I do not have any examples for today. I'll have a bunch for the next one though. I really just wanted to chat more of with these about what we do and how the process works today. And I don't know if you can pull some of the before and afters we have.
I can pull those up.
You can pull them up?
Yep. Just give me 1 sec. There we go. Can everyone see these?
I can.
Got a few.
So yeah, so these are essentially just what we do, and again for the phase 2 portion we're doing, I think end of June. Is that right, Erica?
End of July.
End of July. Okay. Even better. Everything we do, and again, it's important to know whether you're using a service provider or not, is same paint, same colors, same fixtures, same door handles, everything same. We have 100+ crewmen that work on our projects, and if I send somebody to go touch up paint on a different project that somebody else worked on, they're all going to have the same color, which makes life very easy. So we're using the same brands on everything. If I have to send one person to do a door, change a doorknob, it's going to be the same that we use on every single job. The only variations we have really that it comes down to is bathroom vanities. That's really the only variation we have on anything we do. Otherwise, it's the same. So if this is something you guys decide to do on your own, that's something to keep in mind. Don't try to deviate from one project to the next on anything. Just keep it simple. The color we use, the color in here is the same color we use in our houses. It's the exact same. It's called Agreeable Gray from Sherwin-Williams. So it's we use it on $50,000 houses. We use it on $2 million houses. So it's something to keep in mind. But yeah, that's my portion of this. So let's talk about self-directed IRAs a little bit, because I know a lot of folks on here have no clue what I've been referring to. I read somewhere recently, and I'm not sure where I even saw it, that only 8% of Americans even know what a self-directed IRA is, which is mind-boggling. But then again, I didn't know what it was until I was at a trade show in 2006, I want to say. So yeah, I mean, it was early in my career, but not that early. And it, like I said, represents 60% of our business now. So, Brittany, give us the nuts and bolts. What's the self-directed IRA?
So it's funny that, and I agree with you, there is a great opportunity to educate a lot of individuals and investors about this option. It's just very ironic that this has been an option since the 1970s, but people just really didn't know about it. And we might attribute that to the fact that a lot of the large banks and brokerage firms don't offer these investments. So a lot of times we get that question, like, why can't I just go do this through Fidelity or, Morgan Stanley or whatever? Those firms are primarily focused on and specialized in public securities like stocks, bonds, and mutual funds, which is what most people think of when we think of IRAs. So they're not necessarily out there promoting this as an option or providing this education. So it's historically been sort of like a niche, but I think that with growing interest in alternative investments and people looking for other things to invest in, that this is going to continue to grow. But Erica did allude to the definition. Conceptually, it is a self-directed IRA, refers to the ability to, with a retirement account that could be like, function almost like any other that you might have, the ability to expand your options outside publicly traded assets and include what we call privately held alternative assets. So real estate definitely makes up the lion's share of assets that are typically held in self-directed IRAs because of its popularity and relatability, and the fact that I think most or historically has provided stable long-term returns. And it's something that you can see and touch and visit, right? So you're like, hey, I'm invested in this thing, and like it's right there. Like I can go and look at it if I want, versus being invested in stock in a large corporation where like someone tweets something and then the stock tumbles. So it's the ability to invest in things other than just stocks, bonds, mutual funds, a way to diversify, a way to hedge against some of the volatility that we've seen in the market over the decades. We've had two major financial events in the past 10 or so years. Obviously, the most recent being last year. And that's impacted people personally and professionally. Retirement accounts are one of our sole sources of income now. A lot of people aren't going to have enough in Social Security to be able to rely on. And the retirement plans that were being offered through companies, like the pension plans that are offered, are so rare now. There's no more like guaranteed lifetime anything anymore. So these 401ks and IRAs that we have are really the places where we need to be looking to accelerate our wealth. And I think self-directed IRAs are becoming an additional option alongside the traditional, or the regular, I should say, IRA that people are used to. So there's the idea that, okay, I have more options than I thought I had. This can also hedge against some of the volatility in the stock market so I can spread my risk out. Alternative assets tend to be non-correlated with the stock market. So if the market's up or way up or way down, these alternatives tend to provide more stable long-term returns. And then there's also the idea that, hey, maybe someone's investing in these things already personally, where they have interest or a passion about some of these things, and they see what kind of returns they can get in these deals, and they're like, hey, I'm not getting that in the stock market. So how do I accelerate wealth in my retirement account? Maybe looking at adding some additional options. So that's how I would define, well, I guess I kind of also talked about the benefits as well, but I see that as part of the definition is, what makes it unique and different is one of the reasons that people are drawn to it, I think.
So I know we're primarily focused on real estate, but you've got precious metals like gold and silver is a big one, right? What are some of the other things that, I know real estate's the biggie. What are the other ones that are in there?
So I think a close second would be private equity, which could include real estate, but doesn't have to. So some examples of private equity, and of course that's passive, would be investing in partnerships. So some of the things like JV that you talked about, I would consider that almost like a
Like hard
subset
money?
of, but private equity category. Investing in any privately owned company, like a startup in any industry. It could be a tech company. It could be a pre-IPO company. So that's a new and emerging thing. We're seeing a lot of interest in that, and these new companies that are coming out. You know, a lot of them are geared toward like plant-based foods and, you know, climate-friendly solutions. And these are all privately held currently, but someone can get in with the IRA prior to the IPO and get that stock in their account. So, and I should have mentioned earlier that obviously one of the benefits too of using the IRA instead of using your personal funds is when you use your retirement account as the investment vehicle. Once you send the funds out of your retirement account to purchase that asset, anything that you earn, whether it be through real estate, sale, rental income, whatever, dividends through that investment that you're doing, comes in tax advantaged, right? It's tax protected because it's coming back into your retirement account. So it'll either be tax deferred, depending on what type of self-directed IRA you have. If you have a tax deferred one, then it will just stay within your IRA until you decide to retire and start making withdrawals, and then it'll be taxed at ordinary income rates at that time. Or if you have a Roth self-directed IRA, it will be tax-free, which is amazing. So there are the options there, but going back, because I went off on a tangent, going back to your question, private equity is a big one. The other one is lending. So private lending through notes. And that can be related to real estate, or it could be for just about anything. Lending using the IRA as a lender, borrower takes money from the IRA and then either pays back principal and interest or pays back in the form of some sort of equity participation. So again, it's designed as a passive investment for the IRA, really little work to be done. But then of course the IRA is getting that regular flow of income, that regular cash flow back into the account.
Yeah, we see a lot of hard money come from self-directed IRAs.
Yeah, you mentioned precious metals. That definitely is an area of interest. We see that kind of fluctuate depending on what's going on. And then another big one is cryptocurrency right now. Although crypto has tended to shown itself to be a little bit more volatile, there is just a great interest in getting in now, seeing the potential that there may be for this in the future.
Right.
So that is a big one. I'm trying to think of some other ones, like even some intangible things that people wouldn't even think about, like mineral rights or, you know, kind of like leasing. We had someone years ago that bought with their self-directed IRA the licenses to season tickets for an NFL team, and then sold the seats for each game with the self-directed IRA. So there's some restrictions, obviously, and we'll get into those in a minute, but you can get pretty creative within the confines of what the IRS will allow.
Okay, so that would lead me to my next question, which would be what are the restrictions then?
Yeah, so if it seems too good to be true, it probably is usually the guiding principle for this. So the IRS does have some rules, and they do primarily the restrictions are driven by individuals the IRA might invest with and what the relationship is of those individuals to the IRA holder. So for example, if Charles, you wanted to purchase a property as a rental in your self-directed IRA, and you're renting it out, and then you say, you know what, I want to sell this to my son or daughter. Because of their relationship to you, because they're your children, they're your descendants, the IRS won't allow you to do that with your IRA. So you wouldn't be able to.
That's called a prohibited transaction, right?
That is correct, yes. So any improper transaction between an IRA and what they call a disqualified person is a prohibited transaction. So disqualified persons would be you yourself personally, for example, which is why you can't lend money to yourself out of your IRA. You can use it to invest in other things, but you can't borrow personally from it. Any ascendants like spouse, not like spouse, ascendants, descendants, or their spouses are considered disqualified persons. So there are some exceptions because ascendants and descendants are in the linear direction. So siblings, aunts, uncles, and cousins, which are not in that direction, for some reason, we don't know why, but those are not disqualified persons. So someone could use their self-directed IRA and do transactions back and forth with those individuals, or maybe even commingle their funds together to do something. There is an option to technically partner with a disqualified person. So if somebody wanted to go in on a deal, a real estate deal, for example, this is where we see it all the time, and they want to purchase property and they say, I don't have enough cash in my IRA to buy this whole thing. There is an option to get financing, but with IRAs, there are certain rules there too and criteria to be met. So if they don't want to go that route, they say, okay, my spouse or my child or whomever, my parents, could I partner with them? Even though they're disqualified people, I couldn't sell anything to them or buy from them, but we could both go in to the deal side by side and contribute different amounts in funding to this project, where they would own a percentage and the IRA would own a percentage. And then as long as those percentages are kept consistent throughout the deal and the expenses and income are split according to the percentages, that could technically be done. So it seems like a lot for someone who's new to this. They're like, okay, what can I do? What can I do? The reason for having a custodian to hold the account and do the administrative work on the IRA, which is what Next Generation does, is to have a resource for this type of education, to be able to say, I'm interested in doing this type of investment with an IRA. Is this something that falls within the guidelines? Is this something that I could pursue? And then obviously just further educating yourself on examples and different scenarios and the rules, but being able to lean on that resource as well for guidance is important when it comes to prohibited transactions.
Right. Okay. So if let's say I had a traditional IRA, so how do I get it out of Fidelity and get it into Next Generation?
So there are a couple ways to fund a self-directed IRA. So what you're describing is taking funds from an IRA that's held elsewhere and then moving it into the self-directed IRA.
Right.
So in order to do that, basically the investor would first have to open a separate account, which would be the self-directed IRA. And then the IRA custodian, once they open the account, would request a transfer. We call that a transfer of funds from the other account at Fidelity to Next Generation, for example. So that's done from one trustee to the other trustee. And it's not a taxable event. You don't have to pay a penalty for doing a transfer. It's not reported on any tax form. So transferring from one type of IRA to another of the same type is fairly seamless. Another way to get funds into a self-directed IRA could be through a rollover. So if someone doesn't have their money in an IRA already, but let's say they have a 401k or a similar type of plan like that with an employer, and maybe they left the employer and they don't work there anymore and it's just kind of sitting there, that could be rolled over into a self-directed IRA as well. And they can just move over, investors typically will just move over what they need for the initial investment they're looking to do. So it doesn't mean you have to close out your Fidelity IRA and move everything. You could if you wanted to, but you could also just move a portion of what you wanted to work with for your alternative investments.
When you guys facilitate that, or yeah?
Yes, so the process starts with opening the account. And then the second step is funding the account, which we just discussed. So once the account is open, the investor or account holder would work with their custodian step by step to guide them through, here, if you're doing a rollover, here's what you need to do, here's the paperwork you need to complete. If you're doing a transfer, same thing, here are the requirements. the custodian actually initiates the transfer request on behalf of the client, the investor. And then the investment itself is going to require, again, more paperwork, as you can imagine, in order for that IRA to be able to make the investment. And you mentioned earlier, it's a meticulous process. There is compliance that has to be done. When we're talking about tax advantage accounts, not only because anything that has a tax advantage is going to be scrutinized by the IRS, right? Because if you're skirting, that's skirting. But if you're doing anything that's going to lessen your tax burden, they want to know that you're not trying to, jump through any hoops or do anything you're not supposed to be doing. So by us making sure that the paperwork is accurate, the IRA is listed accurately, we're going through all the proper steps to document every single thing and code every single thing if there's any sort of tax event. So our role is to protect the tax advantage status of the account because we know that investors are doing this for that exact reason. Otherwise, they would be doing it with their own money.
Yeah,
So
I think with one of our custodians that we work with, I believe for every taxing redemption, it's 14 pages of documentation that we have to provide. Not all custodians are the same, but that one, they're crazy with the paperwork. But again, that's a good thing,
Yeah, every custodian does have slightly different, I imagine, policies and procedures.
Yeah.
But custodians are also typically regulated entities. So that is also one of the reasons why they probably have stringent requirements. We, for example, are enabled to be a custodian because we are a trust company.
Yeah.
In order to be a trust company, you have to go through a rigorous process to get the approvals. And then once you become a trust company, you are regulated by the banking commission of the state in which you earned your trust charter. So for example, as Erica mentioned, we're chartered in South Dakota. So the South Dakota Banking Commission will audit us regularly. We have to report into the banking commission, provide them documents, regular communication. So custodian is also held to a certain standard from a security and accountability perspective.
Yeah, no, absolutely. No, I don't envy what you guys do.
It's yeah, that's not necessarily the fun part of the process, but we give a lot of credit to our transactions team because they mostly are working on, by the time things get to that, they're working on the ins and outs on a day-to-day. I think the fun part is what we're doing here, which is providing the education and giving people different things to think about that they otherwise wouldn't have, and kind of empowering them to feel good about making a decision, whether it's right or not for them. This isn't for everybody, but at least giving people the information so that they can make their own choice.
Yeah, no, the self-directed IRAs, I think, is a huge advantage. And when I started this business, and I'm dating myself here, but it's when NASDAQ had their first tech crash, and I said, I'm never going to be dictated by the value of a company being based on a CEO that's been hired or fired. And it was like when Intel crashed in '96, I think. And people were essentially went from being millionaires to being broke. And self-directed IRAs puts your retirement in your own hands, and not being based on the volatility of stock markets or today's Bitcoin. It's crazy, or Dogecoin. All right, well, I think we're nailed it on at 2 o'clock. We're right on the head. So yeah, I'm looking forward to phase 2, and we'll get into the nuts and bolts of what we do, and hopefully talk more about what you guys do, and talk more about prohibited transactions, which is something I want to explore more, because that's come up a few times with some of the folks that have tried to explore and do some of the things in the fix and flips that they've done on their own, who are clients of mine as well. They do their own flips, and they've gotten in a little bit of trouble as well. So I'd like to discuss with you guys how to avoid that in their own flips. Well, I appreciate you guys. I appreciate you guys having us on and vice versa, and looking forward to the next one in July.
Absolutely. Thank you. Appreciate
Yeah.
all your expertise and insight. Erica, do you have any closing remarks for the audience?
Well, obviously, thank you everyone for joining. Following the session, there's going to be a brief survey. If you can fill that out, let us know how we did. And if you have any feedback, of course, if you're looking to learn more about something else on part 2, leave that there. That way we at least have some sort of feedback so that we can build out the presentation for next time, and we'll see you in July.
Great.
Thanks, everybody.
Well, see ya. Thanks, guys.
Thanks, everyone. Be safe.